Live as if today is your last day. If you're thinking about compounding, you're thinking about the system and the structures that you're setting up today, generationally, what does that do to your family line? If you're able to not just get all the benefits of using the cash value for multiplication and investments and compounding, but that death benefit, I don't want to overlook that because that is a mass injection into your family's net worth over time as well. And you use that death benefit to purchase additional policies on young children, and then the cycle repeats. So yeah, she started off with $1.5 million death benefit. By age 80, it was 26 million, tax-free to her estate. Welcome to another episode of Wealthwise Banking. I'm here today with my co-host, Jason Sipple, and he's just coming out of the Nelson Nash Institute over the last weekend, the think tank that's held here annually. And Jason, I mean, before we get into today's episode, how was it, man?
It was incredible, Jeremy, and you were missed. I was just telling you before we came on camera, you were missed. I had Brian Moody, Hans, Anthony, I had all kinds of people walking up asking me, "Where's Jeremy?" And Jeremy was digging holes and getting stuff ready. So Jeremy was working hard out in the dirt, right? Like you were like Joe Dirt, keep on keeping on, and just dig in. But it was great. It was they laid out. Seemed like everyone was coming together in a different energy. It didn't feel like it was all about infinite banking this time. It felt like it was about really solving problems for people and helping people see what they're not seeing. And it seemed like the group was closer together. I don't know. It was an incredible experience. A little long-winded, but it was good. Really good.
Yeah, I am sorry I missed it this year. I had originally flight training that was scheduled and then moved around and canceled, and then just trying to get out there because it's a two-leg flight for me. It just didn't work out in terms of timing. So, like Jason said, I ended up spending yesterday digging 28 holes trying to get this nine-bedroom vacation rental up and running before Savannah's biggest party in St. Patrick's Day. I'm a little bit sore, a little bit behind the weather right now, but we're going to keep pushing on. And, part of it is I'm actually pretty excited about this topic today, right? It's a discussion about how a man turned $4,400 into millions through the simple process of compounding. And that's kind of the focus of what a lot of what we talk about in terms of banking and becoming your own banker, right, is the value and the power of compounding. And this example shows firsthand that the earlier you start, the better it becomes, right?
And when we go into this historical figure, one of the founding fathers, you'll hear some of the things about him that you didn't know. Ben Franklin did a lot of cool stuff, Jeremy. Like I was really shocked, and the whole think tank was about Nelson's first principle, right? Was think long range. And so often we're caught, the reason I love this episode, Jeremy, is often we're caught up in busy. We're caught up in what's next, what's going on. Like you're digging holes, I'm flying around the country, or meeting, learning things. But when you think long range, when you think in terms of hundreds, 200 years down the road, what could happen, and then you set up the systems and processes for it, that's what we're going to get into today, where it's going to get into some really cool facts and a little bit of surprises for everyone listening.
Well, one of the things that I found surprising about this, just looking over kind of the outline for today, it's simple, right? If you look back, Jason already mentioned it, it's Benjamin Franklin. Ta-da! Surprise! Founding
Sorry,
fathers.
Jeremy. Sorry, I get
Uh,
excited.
but at the end of the day, you got to think about where we were in terms of technology. There weren't computers, there weren't cell phones, there wasn't a stock market where everyone's day trading, right? Like what he did was simple. And I want to get that across because I think that it's often missed or it's perceived as what we do is complex. It's not complex. There is no complexity here. It's actually very, very simple. And if you just allow yourself to take the first step, really, that's what it is. Take the first step. You start the snowball of wealth, right? Get that little money ball rolling until it turns into an avalanche of wealth.
Exactly, exactly. And when we're talking about it, Nelson's quote, and I meant to share it, is plan as if you're going to live forever and live today as if it's your last day. And when we look at this experiment, as we go in, we're going to show you why builders win and borrowers struggle. And we're going to look at human nature. We're going to look at, it's going to be Jeremy versus me in this example, because we're each going to represent one of these cities. And we're going to go through this together and kind of check out what happened. And let's talk a little bit about what Benjamin Franklin did first, Jeremy.
I mean, a lot of folks know him as, like you said, a founding father. He helped really define the nation, but he was also here for defining or creating fire departments, right? He ended up creating the first library in the country. I believe he was in charge of the Postal Service, if I'm not mistaken, as well, s- universities, and he created a mutual insurance company. And all the carriers we work with are mutual for a reason. So it wasn't just bifocals and lightning rods, right? He wasn't just creating stoves and tools. Benjamin Franklin actually helped craft and shape the rest of this nation. I look at it as this is a man who refused to be bored at a time when there were no computers and things for distracting him, right? He allowed his idle hands to do good work.
Oh, speaking of idle hands, here's a fun thing that Ben Franklin did that shocked me, but he built the first swim fins, Jeremy. And he put them on his hands and he dove in somewhere 3 miles away from shore, swam 3 miles with them,
Hmm.
got out tired and sore, and said, "You know what? These would be better on my feet." And he moved on. And he moved on. This is how he moved. And this fascinated me. Like, not only protecting people, the mutual part of it, that word is super key to how he thought, right? How can we leave things better than we found them? I mean, you said universities, not just universities, UPenn, like one of the Ivy League schools, right? And other universities as well. So it's just the difference is that the tools, they solve the moments, but the systems that he left in his thinking, that solves generations.
Yeah, you said something key there, right? It's the systems, it's the way that you think, it's thinking long range. Near the end of his life, what was it like 1789, I believe? He had that final experiment that he ran, and he never got to see the fruits of his labor, like didn't get to see what the experiment did. It was one of those true multi-generational experiments, but he ended up leaving 1,000 pounds of sterling
Yep.
to Boston. Yeah. And he left another 1,000 to the city of Philadelphia. And this is where Jason goes into, I'm going to be a city, you be a city. I was like, all right, cool. Well, I'm going to go with the city of brotherly love. I'll be Philadelphia here. And I guess that makes Jason Boston.
That makes me Boston, even though I grew up rooting for the Sixers and the Flyers back when I used to watch those sports. But, I felt like maybe it's a little foreshadowing. So maybe as you're listening, pick a city. Which city is going to win when it comes to the end of this social experiment and Benjamin Franklin's vision?
So how did the experiment go, Jason? I'm Philadelphia, you're Boston.
Yep. And it's structured, right? So for the first 100 years, this 100 pounds of sterling that he left to each city, and by the way, that's where he came with the $4,400 per city, because in today's dollars, that's roughly how much it would be. And the money wasn't left to the city. He didn't leave any money to his families, by the way. Right? He had Benjamin Franklin left this money for the first 100 years. The money would be loaned out at 5% interest annually. And the people you had to qualify for a loan, Jeremy. Like you had to be someone who was going to build. So it was only to at this time, it was young tradesmen, men who completed apprenticeships, and it helped them start businesses. And after the 100 years, for the first 100 year, very strict. Only men, only tradesmen, only people who had completed their apprenticeships, who had a good social standing, who had people who vouched for their values, vouched for their character. And then the second 100 years, the money could be used for some public works, and the rest kept compounding. Then after 200 years, you could distribute it however you want. And it wasn't charity, it was structured patience and a vision by Ben Franklin. So let's jump into some of the math of what Ben Franklin saw versus the reality of what happened, Jeremy.
Yeah. So just to recap, it was $4,400 in today's dollars, right?
Yes.
Compounded at 5% for 200 years. That's where we're at.
That's where we're at.
Okay. So if it was compounded perfectly at 5%, it could have exceeded 60 to 70 million in modern terms. I think that was the calculation that we ended up doing before we got on the podcast.
Yes. Yeah. Pretty insane, right? Compound
hmm
interest over time.
Right. But you also put in a couple rules around there. You said that in the first 100 years, it was being borrowed out to tradesmen. And in the second 100 years, it was out for public works. So those governance decisions, right? The rules around the money, they matter. And there are economic cycles. We've had quite a few economic cycles in the United States over the last 200 years, just like any other nation. And human behavior, right? Like you said, it was going out to tradesmen. So these are some of the things that they'll fit nicely in a spreadsheet. And that was what was going on at the time.
Yes, and if anybody's really curious to get into this, I don't want to send you somewhere else, but I want to give credit to where credit's due. The person that wrote this was Michael Meyer, and not the one from the movie, the scary movie, but Michael Meyer wrote Benjamin Franklin's Last Bet. I just looked it up a second ago, Jeremy. This is kind of where all this information that we're sharing came from. So he dug deep in all this. But now let's look at the scorecard. You talked about human behavior. Keep that in mind as we go through this, folks. So, Jeremy, let's talk about what happens with Boston versus Philly,
Yeah.
over 200 years.
So Boston, since you're Boston, why don't you tell us what happened with Boston? I'll talk about Philly.
Okay, so we're gonna go when the trust wrapped up. Now we're skipping a lot of stuff here, but when the trust wraps up after around 1990, this is 200 years after, like you said, Benjamin Franklin's death. Boston finished with $4 to $5 million. Not really that close to the 70 plus $1 million it could have been, but not a bad number. How about you, Philly? How'd you do?
Just over 2 million. So Boston basically doubled it.
Yeah, well, what happened there? Like, why did that happen there, Philly? What happened with, like, why did we outperform you over that time?
Well, I think Philadelphia stayed closer to the original script, right? The micro lending for longer. And if you look at going back into the rules and the governance around it, there were not just economic cycles, but who were they lending to? What were they lending on, right? Boston's trustees focused more heavily on time, on preservation, and reinvesting the capital, kind of the way that I do with my policies, right? We mentioned I was digging holes. It sounds kind of humorous, but I was getting a vacation rental ready. 100% of this 9 bedroom is coming from and being funded by a policy. So where's the capital going and how is it generating, create, keep, and multiply more wealth? Philadelphia, on the other hand, they were on that micro lending model. Okay. So one tend to be financial, like maximization, but they were also looking at like social applications behind it. So those rules around money, and this is why we talk so heavily about, pay yourself first, pay yourself with the interest, the 7 laws of money, right? It's not just meant to be like filler. Like those are actual key principles that people need to be following if they truly want to maximize the compounding inside of the policies.
Yes, and then there's the loan structure, right? Remember, it was 5% annually. It had to be
Mhm.
paid back. There were to end up at 2 million and 4 million respectively. And by the way, I'm glad I won. I kind of set this up, but Jeremy, we just hadn't played a game in a while, and I felt like winning. So I'm sorry that I put you in that spot. I guess I'm not sure what that says about me, but I'm a little uncomfortable in the moment that I set you up to lose. But with that, what happened over that period of time? What happened when the tradesmen came? A lot of them defaulted. A lot of them didn't pay back the loan.
Mhm.
Many did, but more didn't. And you see over time, like even though everything and what happens when you don't pay back the loan, when you're not an honest banker, guess what? You don't get any more loans. And you leave the system worse off than you found it.
hmm Yeah, those small capital rules, clear like governance, right? That's what you need to do when it comes down to money, because no one cares about your money more than you. And I'm just thinking, is like, what was the collateral? Like, did they not put collateral in these tradesmen? Like, I have all these questions that come up that are, in my opinion, commonly known lending habits today, but clearly they're probably not. And this goes back to a couple episodes ago that, no one's taking me up on my offer. I did say that I would mentor someone this year if they wanted to reach out and they wanted to learn how to multiply your money and lend properly and use your policies to do so. But I just don't get it. I don't understand how Boston doubled what Philadelphia did and how they ended up not having proper rules in place. I guess that's if I had to say anything that Benjamin Franklin could have done better, maybe it was set up a little bit more structure and rules around the lending practices.
And some of them, it was a single letter. Was thought about putting the letter in here, his will, like what it looked like and what it sounded like. But back in the language of the 1700s, it would have probably bored you a little bit, and you would have said, "That's it." That one page. Think about that, Jeremy. That one page governed these 2,000 pound contributions of sterling to each of these cities for 200 years.
Mm-hmm.
And so there was some loose interpretation that happened over that time. Again, it goes much deeper. Some, like, I believe it was Boston kept pretty good records going forward. Like they actually digitized them over time and they were available, where the author had to go, and it was one of the two cities, and had to go and literally find in a warehouse, like pretty much an abandoned government warehouse, and go find all of the ledgers to put all this together so we could tell this story.
So let's take it one step further. I put together a policy recently on an infant, and that infant, when we look at basically what her cash value is over time and compounding, she was a millionaire in terms of cash value at the age of 24. So this is a new infant, not even one. At age 80, her death benefit was $26 million. dollars. 26 million. Now, what to Jason's point, and going all the way back to the beginning, right? Plan as if you're going to live forever and live as if today is your last day. If you're thinking about compounding, you're thinking about the system and the structures that you're setting up today, generationally, what does that do to your family line? If you're able to not just get all the benefits of using the cash value for multiplication and investments and compounding, but that death benefit, I don't want to overlook that, because that is a mass injection into your family's net worth over time as well. And you use that death benefit to purchase additional policies on young children, and then the cycle repeats. So yeah, she started off with $1.5 million death benefit. By age 80, it was 26 million tax-free to her estate, so long as it's put into the proper trust, right? And if you want to understand trust structures a little bit, they're not that complicated. You can reach out to me. I'll talk to you about dynasty trusts and ILITs and slats and all the fun ones, right? But when we're looking at the compounding over time, the death benefit, the way that we structure it, compounds over time too, not just the cash value.
Yeah, and it's powerful, and that is long-term thinking. Again, back to what the whole weekend was about, back what this episode's about. It's long-range thinking. On Monday, I have a conversation with a very proud grandmother of a newborn baby girl, Ruby, who is about 15 days old, and we will be starting her policy, to your point, Jeremy. And they don't have to be big policies when they're that young, because over time, you
Mm-hmm.
saw that Ben Franklin turned $4,400 in today's dollars, and his vision was for it to be over 70 million, but it still ended up being 4 million plus for Philly, or for Boston, and 2 million plus for Philly. So
Yeah. Yeah. So if any of you guys want to think generationally, if this is something that interests you, go to wealthwisebanking.com, book an appointment with myself or Jason. More than happy to just check where you are today. And if it's not a good fit, we'll let you know, usually within the first 5 minutes, whether or not you're in a good position to even get started, right? Sometimes you have a little bit of homework. Sometimes we can get started right away.
that's it. It's really finding out where you are today, and it's someone that has good habits, right? We're here to offer strategy to help you build long-term vision. That's Jeremy and I's role, is to lead you and your family forward for generations to come and make today more fun while you're here. Right, Jeremy?
That's it, man. All right. So as we wrap up this episode, we do it with like we have every previous episode, and just remind you that you're already in banking.
You're just not the banker yet.
We'll see you guys next week.
See you next week.
Thanks for joining us on Wealthwise Banking. If today's episode inspired you, please subscribe, leave a review, and give us a like. It's a simple way to help others discover these empowering strategies and join our community. Together, we're building a network of people who believe financial freedom is within everyone's reach. Remember, financial independence is about making every dollar work for you, one step at a time. Until next time, stay inspired, stay in control, and keep building your legacy the wise way.